morning, everybody. Welcome to the Trading Market Technicals morning call video for Thursday, November 15th. Just an ugly day yesterday on Wall Street. Markets down across the board, all red through my watch list. Dow down 185 points, Nasdaq down 36, S&P down 19, gold down $1, and U.S. dollar up about 9 cents. Just a real bad, ugly day. We started the pre-market session up about 4 or 5 handles. I mentioned that yesterday. Really don't read too much into that, because if the market wants to sell any rallies, and that's what's happening, every rally is being sold into. Every bounce is being sold into. And that's why I say stick to the prevailing trend. The trend is your friend. You need to be looking to sell rallies and sell bounces. Now, the problem with something like that is to traders that are trading during the day on a regular basis is that we get to these oversold areas and they're just more risk. Now, we've sold off quite hard here since Thursday, Friday. We had Wednesday, Thursday. Friday we had that little bit of a bounce, and then we've been selling off ever since. And some stocks that are strong are really not selling off, and you don't want to really look to sell those. You want to sell weak stocks. Stocks that have been weak, started this rally, are just really the point of entry doesn't make any sense. So when I can't find anything risk reward wise, I just take a step back and just wait and observe until I see a perfect entry, or if I see a market bottoming that intraday, I can look to get long. Other than that, I would be sticking to the prevailing trend, guys. Don't want to be looking to pick a bottom and or a top. That's not how we trade here. That's not how professionals trade. And again, we don't have to be in this market every minute of the day. We want to preserve capital. We want to safeguard our capital, so when the timing is right, we could pounce on the move and have conviction doing it. Okay. Now, anyway, getting to the econ data. Yesterday we had that key FOMC minutes, and of course, I think we all knew that Mr. Bernanke and the Obama administration was going to further accommodate our easing. Gold did manage to rally a little bit and then sold off, and that's again. Every asset class, when the market starts to sell off, will sell off with it, because you're going to take people that are, and traders and investors that are in a good position, have to sell them and also sell their bad position. So people have this fear, and everything gets sold. Everything. It doesn't matter what it is. Now, I do think gold is going to be a real good investment and a trade coming in year end. Now, we don't want to look to obviously pick a bottom, but if you wanted to nibble in a GDX, like I mentioned, you can nibble small. Now, GDX also had a real bad day. Again, same thing with gold, down $1, but GDX obviously follows what the stock market is looking to do. So we need to really be nimble with that. So if you want to nibble a little bit in GDX and then have a stop, I wouldn't be looking to add anything until we actually stabilize and then look to rally back up again. Okay, so let's get back to the econ data. Now, today we have a lot of key econ data. So this is going to be important here. Can we come into some good econ numbers that maybe the markets actually rally? Not sure. But we did have a decent. I think we had some decent retail sales in the PPI, but nothing really got any market participants excited. They sold right into. So just something to really keep an eye on. A couple other key points before we get into today. I mentioned that we're oversold. The McClellan oscillator is now at negative 87, which is really the area where I like to see a bounce happen. We have now sold off roughly about 8%. The thing that's surprising to me is that the VIX is under 18, and we haven't seen the VIX really shoot up. So that tells me that, well, maybe there really isn't enough fear yet in this market that we have actually put a tradable bottom in. So that's something that I want to continue to monitor. That does not have to happen, but I would like to see the markets really panic here, maybe another down day, and really wash out a lot of the buyers, and then really start looking to build positions on the long side going into the end of the year and have a real nice end of the year. But that's something that that we have yet to see. Now, again, it does not have to happen, but I just want to make a point. Another thing on a timing area, because on a timing perspective, I like to dig into different areas to see where possibly may we have a bottom here. And on a timing perspective, we are at that maturity. We have reached maturity. I think the pullback has reached maturity, and I'll get that to you. I'll show you the chart. Very interesting to see. Okay, so matter of fact, let's get right into that, and I want to show you on the S&P timing perspective. And if you see here, the S&P 500, 2012, we had our little pullback here last May. That lasted 42 days. We were down 9.93%. June 4th was the low, and we rallied since June 4th all the way up into this area here, which was in September. Now we are down about 6.2%. On the 41 trading days. This is 42. I think this is actually even a little bit bigger than that. But nonetheless, it's 41 versus 42. On a timing perspective, I believe that the correction is at its maturity state. So that's something that to keep an eye on. Really for fun, in a sense that I want to keep in the back of my mind. This is not that I would look to be, okay, I'm going to start buying today. No. This is just something to keep in mind as an overall analysis of your technical analysis. Okay, now let's get into the technicals. We talked about the NYMO. Look at where we are from where we were yesterday. We're at negative 54, I believe, and look at it now, negative 87. And look at where we produced some nice big rallies here, and up in here. And here we've been really since July. And if you go back to that May sell-off, right up at that here, that May sell-off, that's exactly where we were, May 21st, which we saw that timing window, and now we're rallied. So I'm looking for in the next couple of days. Now, we do have options expiration, so if we do not rally Thursday and Friday, probably be better for the markets to rally sometime next week and at least get some sort of a tradable bottom in. But again, with options X, large institutions, they readjust their portfolio and they play around with the calls and puts. So things could get skewed. So just take note of that for today and tomorrow. But again, look at this and look at the tradable. Look at this rally we had. So this is something that I want you guys to keep in mind. And so that's why be very careful with your shorts. And if you are short, tighten your shorts up, tighten your stops up, and just be cognizant of where we are here, okay? All right, now NASI. NASI has not, this is a daily, not the weekly that I show you. We have not turned up and at all, breaking above the 3 EMA. So we are still on a sell signal with the NASI. Now, interesting development. Let's talk about that VIX. The VIX still below 18 is really intriguing, and honestly, I'm totally clueless why the VIX has not broken above 20 here. This is where it should be, 19.5, 20, maybe even 20.5, 21, where the market is, and the charts are just so ugly looking. There's still complacency in the market, and this is what's kind of makes me nervous to say, well, maybe we haven't really seen that real sell-off yet. So again, just to keep a thought in the back of your mind is that does not have to happen, but it would be nice to see. Okay, copper here holding in. Okay, nice little divergence. What the market was doing, usually copper would follow suit, actually would lead, and it has not done so. So that could be a little bullish on the bullish camp. Shanghai, same thing with the Shanghai. We did sell off a little bit, but we haven't broken any lows. So this could be an interesting development as well. What I'd like to see is get through this cluster of resistance on the moving average resistance, the 2050 and the 200, and start breaking above and start really moving up to this area here. Then I could say, hey, you know what? With copper moving, Shanghai moving. But again, remember what I said. We're going to have weakness from China. And I don't think that's going to really happen here. And that might really not need to. We might not need to see this in order for our equity markets to rally. But it's just, again, I'd like to see it as an indicator. I like looking at this on a regular basis. Now let's take a look at the dollar. Key area of resistance. This band here is a resistance band. So we could move up higher, right? Maybe get that one more sell-off and then start to really sell off here. So that's something that I'm going to be keeping an eye on. I'll be watching the dollar on a regular basis. If you do not have the dollar future, the DX, you could look at the UUP, which was an ETF. But I really like to see you look at the dollar itself. All right, now let's get into the charts. 10-minute chart here just to show you what had happened. We had a little bit of that bounce, and I wanted to let me see if you could see that right here. We had a little bit of a gap up, very small, nothing to get excited. Now, if we gapped up way into this range in here, I would have been aggressively looking to short, but we did not. So we just kind of gapped small, and then we sold off, consolidated, and then we had the end of the day sell off. I told the guys in the some of the traders that we talked to intraday, I look for a meltdown in the markets itself towards the end of the day because there was clearly no strength at all to the markets at all. And the reason why a lot of guys, like you say, got to be careful. Even in this area, it looks enticing to get short, but this is something that if you're already short the market, if you're not short the market and you're looking to get short from up here, it's just the risk reward is not there, and that's the reason why. Honestly, I just did not do anything here yesterday in the afternoon. The risk reward wasn't there. Where the markets have come now, if we retrace back 38, 50%, and then started rolling again, that would be where your area of your short interest would be. Okay, so on with that. Now look at where we are on the weekly chart. I wanted to show you the weekly. The week isn't over yet, but I wanted to show you we're in this band, this little confluence area of support. Okay, can it hold now? This is where we're going to see on come Saturday morning where the markets close at the end of the week and see if we can get bounce back up here and probably take out yesterday's high of that 1385. That would be a little bit more intriguing. But look at the momentum indicators here, stochastics, MACD, they're all rolling over here. So we are not oversold on the weekly chart. We still have a little bit more to go. But again, just taking a quick look at where we are. ATR, S&P with the ATR, really not there yet. I mean, we're close. We're getting close, but we're not there yet. Just an ugly looking candle for today. S&P, now this is the S&P daily chart. Again, oversold. Our indicators are oversold. But yet we have now broke through the 50. And I mentioned a couple days ago, I said, guys, we're clinging to the 200 where the other indices have broke the 200, the leaders, the Russell, the IWMs, they have broken down. The transports have broken down. There's no way that the S&P can hold the 200 if the leaders are broken down. And look at what we got. Now, we're at the 61.8% retracement is going to be the next target. So the 1347 and 1350 were coming into support. Okay, so this is something where logically we're looking for a bounce here. Now, obviously, we can get down to the 76% retracement, which would be really scary. But we're coming into support here. So really, caution needs to be warranted with the shorts. 60-minute, we had a little bit of divergence, was negated, as you can see here. When there's strong selling, it doesn't matter. Stocks are cheap, PE, doesn't matter. Markets, participants, they're going to sell good stocks to cover their bad losses. Doesn't matter. And that's what I was trying to make a state to a couple of traders that we were talking to about how stocks are cheap and such certain stocks. And it really doesn't matter. Once the market is in a groove and it's in a trend and there's fear involved, it does not matter. Markets will sell off. Spiders, just to show you volume, big distribution day, big distribution. And as you can see here, 61.8% retracement. We're right into this area here. Logical area for a bounce. Now, not looking to pick a bottom, right? We want to see the markets intraday. If you're looking for a move where you think that the markets have consolidated and have now trended and reversed, that's one thing. But to plain blindly just go in and look to buy the market at its low doesn't make any sense at all. That's not proper trading. Anyway, 61.8% retracement here, 135. If I mentioned on the other chart here, well, I didn't have it here, but I said if we broke 138, we'd see 136, and we did. We're actually down at that area now. The Qs, let's take a look at the Qs. We obviously is being held hostage by Apple, but we are now at this area of resistance, of support, and this big cluster area. Look at the volume profiles. If this does not hold, we're going to probably test the lows here back in June. Okay, and that's a real ugly looking chart here. Real ugly looking chart. And let's talk about Apple. Apple, and I mentioned a couple of days ago, yesterday, Apple is in no man's land. The 535 breach, that 534 breach, will send this down to the 522 area. That's my guess, where I see in the charts. And if that doesn't hold, we're going to get to that 61.8% retracement of 492. I know it sounds far-fetched, but it was far-fetched when I said that the 588, which the head and shoulders target, met, and people were telling me 588 when the stock was trading at 640. Anyway, so we're in no man's land. 555 is your buy-in, or 522. I would not be looking to buy Apple in this area here. 522 or 555. That's going to be your buy-in. Now, if we can pivot, make a new pivotal low, and then actually chop around here and start taking out the 549, 550, this area here, then I would say possibly we would look to get in. But you want momentum coming into Apple. You want to see buyers step up, but we don't see that right now. And I mentioned weeks ago, Apple is the largest held position by mutual funds and hedge funds. And with 6 weeks left of the year, they're not going to let their profits go to the waste. So they're going to take their profits. They're going to book their gains in Apple. And that's what actually helped a lot of the hedge funds, because Apple kept on climbing and just kept on moving higher and higher and higher with buyers. Now it has clearly reversed. Apple is broken. The stock is broken. Even if the stock ran up to 592, 600, I would say you're going to have some big area of resistance. Apple has a lot of overhead resistance to cut through before it can even test 700. So anyway, that's Apple. Just use a little caution. I do not trade that stock. But it's something that I get a lot of comments on it, and a lot of traders ask me to comment on the stock. Okay, Diamonds last is the Diamonds Dow Jones ETF. Ugly candle today. This could it be capitulatory? Possible. I don't think so. I think we have a couple of more days chopping around here before we look to get back up above the 61.8%. Looks like the Dow was actually down into the 71.6% retracement. So just a word of caution. Ugly day yesterday, guys. Please do not look to pick bottoms. It's not worth it. Wait for the market to give a sign that maybe the selling has subsided. We are coming into earnings. Options expiration. So really anything can happen. If you're uncomfortable, take a step back. Cash is a position. And then next week we can roll into possibly some long trades. And that's what I'm looking for right now, is looking to get long when the market tells us to get long. Have a good day. Be safe out there. We'll talk to you tomorrow. Take care.